Welcome back to Retirement Lifestyle Show. I'm your co-host Adrian, and I'm joined with my fellow co-host Roshan. We're back with our second episode of March, and I'm really looking forward to this episode. I think we're going to have a lot of great content. Roshan, I'm excited to have you back again for the podcast. Really looking forward to our topic today. So tell our viewers and listeners what they should expect and what kind of information they're going to get on this next episode of Retirement
It's great to
Lifestyle
be,
Show.
yeah, it's great to be back in another, and that should continue. So hopefully that'll be the norm going forward. But what's interesting is the topic we had today, we had debated doing for our last topic, which is just looking at the conflict with Iran. And, our previous recording was actually 3 days, I believe, before uh, airstrikes began. And so now we're reviewing the topic. What makes it interesting for today is we can discuss the expectations and what's happened so far. Although this is definitely a something dynamic that's constantly changing. So what we talk about today might be completely right on or completely irrelevant in our next recording. But that's the way we can look back and test it.
Yeah, I think that's a great topic for us to discuss today, especially looking at it from like an economic and financial lens as well as, financial planners and investors. We're constantly always trying to stay up to date on everything that's going on because, it just has ripple effects across a number of different areas in our society. That's for sure.
Well, that definitely is, and we're, as you mentioned, talking about the financial side of things, not by any means trying to minimize the human life effect that's going on. Just going through the numbers and looking at it from um, really trying to understand the way the market looks at it. So let's go ahead and jump right into it. And I've spent a lot of time looking into this, both before, as I mentioned, we discussed reviewing this last time, and ongoing. And we actually did an episode a few years ago when Russia attacked Ukraine, and a lot of the stuff from that still holds true today. So some of the basics being, first, typically 8 weeks after uh, a strike begins, the equity markets move higher 95% of the time. So typically the market will absorb the change in what's going on globally, and then it'll move forward. Um, and like I said, 95% of it's up, and it gets back typically to where it was or the themes that were going on prior. Uh, and once again, this is 95% of the percent of the time. Now, the themes that were going on prior to the conflict was there's a rotation from growth to value. There was a rotation to international from U.S., which started really last year, and there was a software sell-off, which is what we discussed on our previous episode, a software sell-off driven uh, by Anthropic's Claude uh, AI being able to essentially build software for us. So in general, once again, 95% of the time, the market absorbs this, gets back to where things were and those trends. There is that 5% of the time, though, and that's when there's a severe extended conflict. If this is not short, if oil can't travel through the Straits of Hormuz, if there is significant disruption to oil production and capacity, that would definitely risk us being in that 5% neighborhood where it's not up. Now, right now, with everything that's going on as we record this episode, the expectation is still the shorter lived conflict, but the risk is always there, and things are definitely different now than they were in 1973 when we had the uh, oil uh, oil supply disruptions. which I'll go over as well. But Adrian, any thoughts on what we've started with so far?
Well, the first thing I'd probably want to talk about and just kind of give more background on it is just, what has the market been doing leading up to this, this conflict in the Middle East. And I'm actually going to go back a little bit further and just talk about like last year around April was the last time we were really experiencing a lot of volatility in the market because that's when we were kind of in like a second trade war, so to speak. There was tariffs going on, and that really shook up the market. You saw some of the major indexes like the Dow Jones and Nasdaq, the S&P 500, down roughly 20%. And then markets started to recover. Some of the tariffs were getting pulled back, and then the market was doing very well from April pretty much up into last October. And the reason why I'm talking about this time frame is because again, there was a lot of volatility back in April. Markets recovered, and then we got to the end of October, and then that's where markets sort of peaked out. Where if you kind of invested in the major indexes like the Dow Jones, Nasdaq, and the S&P back in the end of October, and you look at the value of it today, you could be slightly down to flat. Where the markets have been pretty much range bound since last fourth quarter till today. And I think that's kind of significant to talk about because, again, that range bound that we're seeing in the markets this year. And just to add a little bit more background on it from like a technical standpoint, when markets are sort of like range bound, they're not really going up, they're not really going down, they're kind of staying in this trend. You could see a little bit of a built up support in the market. Whereas, let's just say the opposite happened. We had a lot of volatility last year with tariffs. Markets recovered, they continued to go up. And let's just say we had a really strong fourth quarter, something that some people were looking at last year that I thought may happen. They call it like a Santa Claus rally, like the last month of the year in December, you could see the markets run up, except it was kind of the opposite. You saw a little bit more volatility. Markets pulled back a little bit towards the end of the year, where we didn't really cut into or experience some gains that could cut into this year. So I'm saying all this to kind of, say that I know past performance is not indicative of future performance, but if we really did have like a strong rally into last year, we had a strong start to the first quarter this year, and then we had this conflict in the Middle East, you could probably see, a lot more volatility, shakeups in the markets, and the correction. Where when this news first broke a couple weeks ago, people, I'm sure you saw it, and heard about it and talked about it. People were very concerned. Are we going to have a significant drawdown in the market? Is there going to be a pullback? But again, the markets continue to be in this kind of whipsaw range bound area. I mean, you're seeing it the past couple of days where the market may open significantly down, and then by the end of the day, it's positive. It's really hard to kind of pinpoint where this market is going based on everything that's going on in the world right now. And I think that's something too that is going to be interesting just to follow. Are we going to break to the upside? Are we going to break to the downside this year? Are we going to continue to stay range bound? And it really is like a headline by headline case where we're just waiting for more information to come out and just see where we go from here.
Yeah, and I would say I agree with the range bound thing that you're saying. If you extend back, when you extend back to that October timeframe, the last few days though, I think that's really just driven by news related to conflict with Iran and news related to oil. Right, like yesterday, we're recording this on Wednesday the 11th. Well, yesterday the markets went up literally towards the end of the day based on a now deleted tweet about U.S. Uh, getting tankers through, escorting tankers through the Strait of Hormuz, right? And which I believe at this point it's turned out to be inaccurate. However, let's see what happens next time and what news comes out, whether the story changes on that. But what you had said about it being range bound, going back to what I'd mentioned about the themes for the year, The S&P 500 overall has definitely been range bound. I'm looking at it right now as we speak, and at in real time, it's actually down 0.95% this year. Uh, However, the equal weight, now the S&P, we've talked about this before, but I'm going to review it for just so for new listeners they know what we're referring to. The S&P 500, the 500 indicates 500 companies, 500 large US companies. It's cap weighted, meaning you own more of the bigger companies than you own of the smaller companies. If you look at the equal weight, so as I said, that's down about a percent on the year. If you look at the equal weight, that's actually up 2.45%. So when I had referenced earlier that some of the themes will continue, well, that's sort of showing the rotation theme right there, right? Money's rotating from the larger companies in the S&P 500 to the smaller companies or to other companies, not necessarily also to smaller than the largest, but not necessarily to the smallest. But you've got that rotation happening, which you're seeing while you're seeing the equal weight go up, while you're seeing the 500 index being range bound, right? So that's definitely a theme in what you've seen going on. And just looking at the range, you had mentioned the 6 month time frame, and we're literally right in the middle of that range right now. I'm using the um, SPY as a proxy, which is the State Street Spider S&P 500 ETF, and that looks like it's peak over the last 6 months was just a few weeks ago in late January at right around 697.50. Its bottom was at in right late November at about 650, and right now it's right in the middle of that range, roughly at 676. So Adrian, as you mentioned, in that range, is it's definitely staying close in that range right now.
Yeah, it is. And I just the term I guess that comes to mind is sometimes this can be just like healthy for the market because again, when we have just a sort of a melt up in the market, that's where you can see some like institutions, some investors, some organizations really just piling on the risk when everything's going up. You can't go wrong. And then this sort of volatility hits the market. There's some concerns out there, some fears, so to speak, and then that's where you can kind of see a little bit of like a washout in the market and certain speculative assets, and then that can kind of reset investor sentiment and expectations, where you could start seeing money move from more growth speculative back to some more quality. And as it kind of just stays in this like range bound that we've been talking about, it could kind of be some built-in support for the future if things start to recover, things look a little bit better, or we're starting to get some more like positive headlines going out. And that's kind of like my final take on this. Obviously, the opposite end of it, where more bad news could come out. We could get bad like expectations or another bad round of earnings, even though last batch of earnings have been pretty solid for the most part. There's a lot of number of factors that could pull the market back down, and then this sort of range bound that we built up cannot be healthy because it could cause like a new resistance level for the market to break through. And this is all from kind of a technical lens that I think that's fun just to discuss and talk about on the podcast.
Yeah, and just giving an explanation on that, technical analysis is reviewing the movement of stock price, where fundamental is reviewing like the uh, details of the stock itself. So I definitely think that's interesting. Now, when you went on there, and let me share our disclosure. This is never advice. This is just what we're seeing. We're sharing it with you. It's an opportunity for you to think about this, do and figure out where you'd want to research. So really is a good prompt and almost an idea generation that we're doing here. Once again, not advice. And Adrian, as you mentioned, the range bound thing, as we've discussed before many times, I like to do covered calls, which is a way to generate income on a portfolio. And that had me saying, hey, this looks like it might be a good opportunity for that. I was looking at the numbers, and volatility was up. It's actually settled pretty close to where it was before the conflict started. So when volatility is high, you can get higher option premiums. So I went and did my quick quick review, and prior to this happening, this conflict, I was definitely definitely looking at the markets and the covered calls, and it just wasn't getting the yields that I would like. They were tighter than I would like, meaning that in order to get the covered call yield I'd have to stay closer in to to the to the current price of the market. And what I'm finding is that I was hoping, when with the range bound discussion, as I started digging, that it would have changed a little bit, but it still seems like the case. Once again, I'm using the index as a proxy, but it so that's not as good as I had hoped when you started with the range bound. As my mind is thinking, well, how can I use this range bound as a potential profit opportunity? But I'm sure there are other things that'll come up as we continue. What else did you have, or what other thoughts did you have, either around the markets as a whole, as you're discussing right now, or around the conflict?
So one of the quotes I heard that I found very fascinating and really hit home was volatility is the price you pay to be in the market. And that's kind of one of the, like, when I heard that quote, I was like, I can't wait to just talk about that on the podcast, because that just makes so much sense. It can help investors. It can really weather a storm or negative news or headlines or just a lot of things that are going on in the market and the economy. Volatility is the price you pay to be in the market. And what this really means is, you take volatility, which are price swings, price going up, price going down, sometimes in very significant moves. And you being able to stand, especially the downs, is what you have to endure to get those higher expected long-term returns that everybody invests for, what everybody wants. And that's something too that is a very good way for you to stay a disciplined investor and a long-term investor when there's volatility in the markets and there's a lot of concerns going on. So I thought that was like a really great quote to share. What's kind of your takeaway from that? Have you heard that before, or did you hear like a different like term or quote regarding that?
No, this might. I don't have a good quote. But what yours quote said, volatility is the price you pay for the markets. I'd almost flip that and say volatility is the opportunity the market provides you, right? Because if
Yeah,
you're able to take advantage of it, that would be great for you. That does remind me of two um, well-known investors, and their quotes. One is Buffett, when he says the markets pass money from the impatient to the patient, right? And that concept being, the impatient guy is the one that's just selling while they're worried about things going down, while the patient investor is just sitting there and holding, right? And gradually that money, because that seller is going to rebuy at a higher price theoretically if it was the wrong move, but they're doing it because they think it's the right move. And then the what lines up better with my spin on your quote, being volatility is the opportunity the market provides you, is just Benjamin Graham and his analogy of Mr. Market. And he had said, imagine Mr. Market is someone that you know that provides you a price for a stock every day. And sometimes Mr. Market is feeling really great, so he'll give you a high price, and sometimes Mr. Market is feeling real down, so he'll give you a low price. And that's reminds me of the Mr. Market concept is one that your volatility is the price you pay quote reminds me of.
yeah. I mean, I like all of those. And again, they're just quotes to kind of stick by or think about when there's ever like market volatility going on, or you're having just concerns with the overall like market and the economy and the geopolitical risk out there, which is kind of like the backdrop for this episode, it's just a great way for you to kind of look at it, think about it, and just see how you can apply it or how it can just be very practical to your situation.
Yeah, and I'll actually share it. A quick story that this reminds me of too with volatility is that I joined this business full time professionally right in 2000. I was an assistant prior to that. I did some a little bit of analyst work prior to that. But when I say this business, I mean working with individual clients, helping them with their retirement and managing their portfolios in the 2000s. And if you think back, that's the tech bubble bursting. So partly because I think of my time frame of coming in the industry, I spent a lot of time, and I'm going to change the word from spent to wasted, in my opinion, a lot of time trying to figure out a way to avoid or minimize volatility, right? And what I've learned through my research and through my experience is that, as you said, Adrian, at the beginning, volatility is the price you pay, that you really need to be accepting the volatility. And as I had said, taking it a step further, trying to be opportunistic with it as opposed to trying to avoid it. And here's what that means to me. When you're trying to avoid it, you're thinking there's volatility coming or the markets are gonna go down, so let me sell. Right? That to me is what avoidance means. When you are trying to take advantage of it, you're not trying to be predictive and saying the volatility is coming. You're saying the volatility is here, things are down. Let's go in and take advantage of this volatility, which is our previous episode, why we spent all that time on the software stocks, right? With the major drops in there, is that an opportunity, right? Once again, taking advantage of the volatility in that scenario is what we're trying to do. So, and when I say, as you said, the volatility is the price you pay, but being accepting of volatility means it's the price you pay, as you said, and don't make any crazy moves, major sells because of it in particular. There's nothing wrong with holding, and then taking advantage of it is the opportunistic side of things. My favorite quote, and I don't want to misquote him. I guess I will because it'll take me longer to find it. So I apologize. But Peter Lynch has the my favorite quote about the subject where about selling is or predicting a market decline. It's that far more money has been lost anticipating a market decline than the decline itself. So if you're trying to predict it, and once again sharing my story, I remember. And I'm going to get the number slightly off, but it was roughly 2013 where I was reading a lot and seeing a lot about markets being overvalued. And at the time, there was a lot of talk of the Buffett indicator, which is market cap to GDP ratio, and that things were getting expensive now. And the move then, if you're trying to be predictive of volatility, would have been to sell and wait for things to pull back. Now, I don't know when you would have gotten back in, but if you had sold and you kept waiting for that specific indicator to come back, that Buffett indicator, you would have missed roughly a tripling of your numbers. So for any of our listeners that goes back and runs the numbers, or if I run the numbers, I'll share a more exact figure for you. But the concept is unchanged, right? At the time, there was fear of the markets that the valuations had gotten too high. And if you had sold and said, "Hey, I'll get back in when valuations are better," you would have missed roughly a tripling of your money, right? And now looking back at that, uh, my opinion on this is the flaw in that analysis back in 2013 is I think it compared things historically, and compared historical averages, where in actuality you needed to make adjustments because of our low to no interest rate environment that we had at the time, which will fuel higher valuations. So that's to me, from what we've recorded and what we've discussed today, Adrian, I would actually say this is the most valuable part, right? What your statement of volatility is the price you pay, taking that a step further to volatility is the opportunity the market gives you, and then taking that even further to saying just be accepting of it and using this 2013 analogy. I think that can hopefully um, keep people in and avoid people pulling out due to volatility and losing money or losing opportunities.
Yeah, I think you made like a lot of great points. And, we're in March. We're not even closing out the first quarter yet. And it's a lot of things that we talked about that can help you with whatever the markets and the economy throw your way. So I definitely liked a lot of things. Are there any other points that you want to add or any final takeaways for our listeners and viewers before I close this out?
Well, actually, I want to take us back to the Iran topic for a moment and just share a couple other pieces. And so, in doing my research and analysis and just in everything that's going on, I'm going to share one thing that I found really interesting and really valuable, and then just share where things have actually gotten. So, and I need to thank Goldman Sachs Asset Management as well as the Investment Strategy Group and Turning Point Market Research for the data on here. But what they did was they had looked back over the last 4 decades. There have been 21 U.S. airstrike campaigns in the Middle East and North Africa, and this starts the first date they have on here is April 14th and 15th in Libya under Reagan Operation El Dorado Canyon, extending to really. Syria in December 19th of 2025, including Operation Midnight Hammer 2020 June of 2025, and it does have the start of the data, but the numbers aren't finished. Now, typically in the immediate aftermath, there's equities declined, crude oil, gold, bonds, and the U.S. dollar rallied. Um, Now, what's happened so far? We're a couple weeks in. Uh, Equities are slightly down, not as much as expected. Crude oil has gone up. Gold is flat to down. Bonds are, I believe, slightly up. I'm going to look this up to confirm with the proxy I'm going to use as the overall bond index to confirm that for us, and I'm going to give us an estimate uh, on this on the bonds just to see if we look at this. Um, and bonds I'm looking at right now, they're actually flat, not necessarily up, and then that was bonds. The U.S. dollar is slightly up. So looking at what's typical, equity slightly down, that's in line. Crude oil up, that's in line. Bonds and gold are typically up. They haven't gone up as much. I do have some thoughts on that. And then the dollar typically rallies. Now here's where I think it gets very interesting. Um, 8 weeks later, 95% of the time, stocks are up. Uh, Only a third of the time does oil sustain their gains, right? I'm sorry. Yeah, only a third of the time. That number did surprise me. Gold maintained its gains 57% of the time, and the dollar 52% of the time, and the bonds 52% of the time, right? So it really is equities 95% of the time were higher. It's a coin toss for gold, the dollar, and the bonds, and crude usually gives back those gains. So that's to me that was very useful information. Now the caveat I gave earlier of if it is extended or there's a lot of oil infrastructure that takes a hit, that could change things. So as I said at the very beginning, it is dynamic. However, I was surprised at how crude gave it back 2/3 of the time, and it really is a coin toss with the others. Now, as I mentioned, with what's actually happened so far, what was interesting to me was gold has not really gone up, usually being the safe haven, and I can't prove this, but it feels like it's a buy the rumor, sell the news scenario where gold had a run up before, and then the news hit and it had a little bit of a of a of a sell off. Not positive that's what happened. That's just what it feels like to me. But going back to this, if you're looking at, well, what do I do with all of this? Accept the volatility, Adrian, as you had said, and then are there an opportunity in some of these other areas, in particular, that stock market being up 95% of the time, and uh, you know, oftentimes when we have this market decline, and Adrian, I think you were alluding to this with the volatility comment. Um, you'll hear stats that say, if you miss the X number of best days, whether it's 5 best days in the market, 10 best days in the market, instead of having X amount of gain, you ended up flat or negative if you miss those days. Well, in a situation like this, um, what you had said with accepting volatility is so important, because what's going to really cause things to go up, right? It's going to be an end to the conflict, right? And you're not going to be able to predict that. So if you're not going to be able to predict that, you're looking at a market that's range bound and flat, and your goal obviously being you want growth in your portfolio. Um, if you're not going to be able to predict when the conflict ends, I think your options are then just to accept the volatility. And as I said earlier, as I'm saying again, this is by no means advice. Um, Adrian and I share the topic, and then we uh, do our own homework and research and analysis. And then when we speak on the podcast, it's very much just a discussion of what we're naturally seeing and feeling. So it really isn't advice. It is. Us having a candid discussion on it. But that's sort of the conclusion I'm starting to come to. And I shouldn't say starting. I'm using that as a qualifier because I want to be clear. This is not advice. But as we have this discussion, Adrian, going back to what you said about volatility, that's really the conclusion I'm coming to. From if you're a long-term investor, you do your research, and if you think this is going to be a shorter conflict, then if that's the case, 95% of the time the markets are up, you really don't have to take much action, right? And you expect the markets to resume the themes that they had earlier in the year, which is that shift from growth to value to international from US, and that software sell off, just monitoring it and seeing if there are opportunities there.
Yeah, I totally agree with that. And kind of just maybe like a sneak peek on like a future episode, which we'll probably discuss. It's kind of like the economic ramifications from all this as well. As we know, like economic indicators and data, it's always very lagging. So we don't really know what kind of long term or, in the next couple of months, this impact will have. I mean, one of the biggest things people are concerned about is just like inflation. That's definitely something that people are looking at. I mean, we did get inflation numbers today that were in line and as expected, which is always good. But that's something too that, I think we're just going to have to talk about, and our viewers and listeners should be watching over the next couple of months, because inflation has an impact on what's going to happen with rates and prices, which we all know affects everybody's everyday life. And that too can have sometimes a correlation and an impact on markets and performance as well. So that's something too to kind of give you some parting thoughts to think about as we go through all this information, this news, and all this geopolitical conflict that's going on as well.
Yeah, that sounds great. That'll definitely be and with us recording this in a couple weeks, I think there'll be a lot that's changed too. So that'll be a great topic to touch on. Um,
Yeah, I'm
it's great
definitely
to be
looking forward
back.
to it.
Yeah, it's great to be back, and uh, for all of our listeners, it's great to talk to you again. Please send us questions that you have. Like, subscribe, give us 5 stars, take control, and achieve your goals. This has been the Retirement Lifestyle Show.